Yeah, people could not raise money at all. And so everything got marked down. Everything got super cheap and really interesting. I don't know why people don't learn this. I mean, even now, you just see even VC funds can't raise money yet. And they'll really raise money when they get, let's say, Bitcoin's over 100,000. And before you know it, everyone's investing in the late cycle all over again. They just rinse and repeat. The other thing that's interesting is obviously because tokens give you exits essentially earlier, I wonder how much of the equity of all of this actually gets realized. And do founders care in the end about the equity? That's another thing I'm trying to get my head around, whether we've created a sort of perverse incentive without realizing it.
Renowned crypto expert Raoul recently discussed key crypto issues with fellow enthusiast Chris Burniske, covering topics such as airdrops, the tokens economy, and the future of crypto adoption. Raoul thinks that the market will eventually move toward an ICO model in which 70% of tokens are released early, and that there will be less need for fully diluted valuations, FDVs. He worries that this strategy might result in incentives that are not aligned, as was the situation with EOS when participants lost interest in the project after receiving a sizable upfront payment. Since teams don't get paid in full upfront, they are more likely to concentrate on driving value and economic models, according to Pal. A high FDV and low float encourage teams to strive toward future growth. He emphasized the remarkable rise in the cryptocurrency market, pointing out that since 2011, Bitcoin has increased in value by 150% annually, and that early-stage tokens like Ethereum have grown even more. Pal added that achieving capital efficiency is difficult due to the ongoing generation of wealth and the inflow of fresh money. On the other hand, he indicated a desire to investigate different strategies, like the SU trip, which abstracts complexity and makes technological advancements. Pal says that the secret to success is to integrate crypto with the larger Web 2 environment, so that it is available to a larger audience. Watch clips from the interview for further insights into Raoul Pal's conversation with Chris Burniske. Please like this video, subscribe to the channel, and turn on post notifications for more content. Enjoy the video.
The other thing I'm trying to think through is the market now wants less FDV. And they want, let's say we go to the ICO model where 70% of the tokens are released early. The other issue I have is having seen things like EOS is the moment people crystallize that much money, they don't give a shit about the protocol or the thing because the alignments get misincentivized. And I'm not sure, and I'm still thinking this through, whether a high FDV, low float actually forces those teams to really drive value and economic models because they don't realize all of the money up front. Because the more you realize money up front, you get capital now for future work. So you're less likely to do the future work because of the incentive structure. My view on this is the issue is even Bitcoin alone performs at 150% a year since 2011. And the earlier stage high adoption tokens, Solana, Ethereum, are much higher. So the amount of new capital and wealth it creates just means this endless capital gets recycled into the system. And until you see network growth slow down, and we're barely there yet, we're only still going up the exponential curve, it's difficult to think we can get capital efficiency. The only way, I guess, is at the tail because there's so many tokens launching. Yeah, I mean, I've been very interested in following the whole SUI journey just because these guys are really at core Web 2 people who then became total experts in Web 3 and just seeing how they're abstracting away a lot. And also, they've got a lot of technological breakthroughs, the whole new Mr. Sentai thing, Mr. SETI or whatever it is, the latency, that latency is really important in a Web 2 world because we're used to zero latency. But in crypto, we're used to latency and it's actually a bit clunky. So there's a lot going on there. But I do think you're right. I think the big breakthrough is going to be integration into that gigantic world of 8 billion eyeballs or 6 billion eyeballs. The Blinks one, at first I was really like, this is incredible. And it is great. But I use a Safari browser. I can't even see these things. Even if I use Chrome and I gave it to a friend who's not in the space, if they don't have a wallet, it's nothing. So it's actually for crypto people when they're having a Web 2 experience. We haven't actually bridged that gap to make it Web 2 for Web 2 and nobody knows what it is. This is the underlying, it's the new underlying infrastructure for the internet. as we've talked about. And people get confused. When I go around marketing our Thunder funds, people get confused still but there's this Bitcoin narrative, this narrative, that narrative. And I'm like, stop. These are all decentralized businesses that sell block space. And they have different qualities to their block space or a different narrative on what makes their block spaces effective. And that is, once people see that these are essentially decentralized businesses that operate and sell block space, people start to understand. And what's unique about this infrastructure layer, it's the first infrastructure layer in history that we can all participate in because of the behavioral incentives of a token system versus equity. And so when I look at it, I just look at the growth of the space, and it grows at 100 and something % a year, which is twice the speed of the internet, because obviously it's built on internet rails, so it should go quickly. And I just extrapolate that trend out, and I look at it, and it's like, well, it's a $2.5 trillion space today. If we carry on, by 2032, it's 100 trillion. I'm like, that's the largest accumulation of wealth in all human history in the shortest period of time. Even if I'm wrong by 50%, because I'm a total moron, it's the same as 100 years of value accrual of the S&P 500 in 8 years.
Right.
It's bananas. It's because we can own this adoption layer, and all of these businesses selling block space, that's all it's about. Best thing is just try and capture that growth first. If you're going to do anything in the space, stop trying to focus on the one thing. Just capture 2.5 trillion to 100 trillion. You'll be absolutely fine.
Speaking about the possibilities for an ICO model with an earlier token distribution, Raoul Pal talks about the cryptocurrency market's shift towards less FDV. He emphasizes the significance of expanding accessibility to cryptocurrency and integrating it with the larger Web 2 environment. Airdrops appear to have unfavorable effects despite their popularity in the retail sector. To benefit, they encourage users to dump tokens quickly, which causes salary disparities and instability in the market. Because they make less money each month than someone in the US, someone in the Philippines might sell a token for a profit of $10. In NFT communities, this pattern is repeated. Originally, the goal of airdrops was to give ownership to people without access to cash and to reward early investors. But they've become dependable and have drawn farms that take advantage of the setup. Insincere actors are difficult for well-meaning business owners to weed out, which results in overpromising and dissatisfaction. A smaller portion of tokens are now flowing to actual participants due to the industrialized airdrop farming complex. Due to their rarity, early airdrops like Uniswap and Goo were effective. On the other hand, overfarming has made recent airdrops less bountiful. Airdrops appear to be useful just for token launches that comply with US regulatory requirements at this time. This leads to an unbalanced market structure, which makes it suboptimal. The 2017 initial coin offering, ICO strategy, which saw 50–80% of the supply go through on day one, balanced the market. Some tokens and apps have been destroyed by airdrops, which have turned into teen angst. Intimidating actors are drawn to launches with high valuations and dependable airdrops, which causes instability in the market. Airdrops should become less of a priority in favor of building a more equitable market system. Let's go back to the interview and watch more clips to gain insights from Chris Burniske.
I know the ecosystem, particularly retail, loves airdrops, but they seem, and in token incentive systems, but they seem to create really bad outcomes because they are more incentivized to dump it as fast as possible to capture it. We found this even in NFT communities. You're finding wage gaps. So you're finding, let's say somebody in the Philippines will dump anything down to a $10 profit because their monthly wages are less, while somebody in the US may not. Time after time, we do the airdrops, we kind of try and bootstrap the network, and people just take it and f*** off. And I'm like, are we destroying the whole thing by doing this, by creating this complete insanity around airdrops?
Well, we're not destroying it because some of the core blockchains are indestructible. So I'm reassured by that, right?
I'm not thinking of the core blockchains. I'm more thinking of the applications that come with kind of airdropped incentives.
Right. Okay. I think, well, we're in teenage angst, and I think we are destroying some of those tokens and some of those applications, because if you launch at too high a valuation, well, okay, let's go through the whole process here, right? Airdrops right now, the norm is 10 to 20% of the fully diluted supply gets airdropped. And that came from a good place, right? That came from the early thinking of that was, let's reward, the early stakeholders who come together to actually make this network have utility, right? So it's giving ownership to people who don't have the capital access to buy in at an early stage and earn it through their labor, or some combination of labor and capital. Good intention, right? But now it's become so predictable that there's all kinds of farms, right? And like having seen how well-intentioned entrepreneurs have tried to go through this and the amount of work it takes to try and, filter out all the sybils, or, just let's call them disingenuous actors. I don't want to call them bad actors, but disingenuous to the intention. It's so much work. And then everyone is unhappy because everyone basically got overpromised to about what they were going to get. And they also the fact that it's become like airdrop farming or like the industrialized airdrop farming complex dilutes the amount that goes to people.
The
right?
industrialized airdrop farming complex. I love that.
Right? That's what it's become. And so it's lost the genesis of, what it made it powerful for people. Because if you do look at some of the earlier airdrops from last cycle and this cycle, they've been powerful. Like Uniswap was powerful last cycle. Jito was powerful this cycle. That came early. That came last year, right? Late 2023. Surprised people. Generous because it was not widely farmed. So the more widely farmed it is, the less generous it is going to be for every individual for the most part. And so there's that frustrating, inverse correlation. And, even I would say the Celestia airdrop from early this cycle was also quite effective. But like when Celestia airdrop happened, people were asking, what's Celestia? As opposed to like you come to the here and now and the most recent big airdrops, everyone wants the token, everyone is talking about it, but then everyone's disgruntled because they're all crowded in. So I would say at this point, like the utility of airdrops is to allow for a compliant launch of a token in, this red tape US regulatory environment, right? And that's suboptimal as well, right? Like I would prefer, at least from a market structure standpoint, the ICO model of 2017, where you had 50 to 80% of the supply circulating upon day one, right? Because that allows for a much more balanced market structure as opposed to a top heavy, long duration market structure.
Meanwhile, U.S. Treasury Secretary Janet Yellen has warned that the country's enormous $34 trillion debt load is driving away foreign exchange reserves and stoking collapse concerns. The increasing acceptance of Bitcoin and other cryptocurrencies as an alternative supports this trend. The price of Bitcoin has surged over the past year, despite a warning from the Federal Reserve, aided by bettors who believe former President Donald Trump will win the White House once more. Yellen's fears are compounded by the fact that the Project 2025 policy plan is positioning Bitcoin to collide with gold. Since Russia already encourages using Bitcoin and other cryptocurrencies, she worries that U.S. financial penalties would lessen the dollar's influence globally. Yellen informed legislators that nations seek to avoid using the dollar in international transactions as the U.S. imposes more sanctions. Larry Fink, the CEO of BlackRock, has also expressed concern about the mounting national debt. He feels that because of the U.S.'s enormous spending, which is increasing at an unsustainable rate, future generations will bear a heavy weight. Fink advocates expanding the economy and lessening the negative effects of the deficit on it. Moreover, economists at Bank of America had recently cautioned that the U.S. debt load is growing by $1 trillion every 100 days, driving up the price of Bitcoin. They observe that as investors look for alternatives to the dollar, it makes sense that debt debasement trades are getting close to all-time highs. As we conclude, what are your thoughts on this interview? Do you think the convergence of Bitcoin and AI is possible? How else do you see this playing out? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.